Welcome to vTalkInsight, Allocator's Lens Daily for February 12, 2026. Today's cross-asset picture is dominated by a sharp tug-of-war between surprisingly firm U.S. payrolls, delayed Federal Reserve rate cut expectations, and an equity rally that is broadening well beyond megacap technology. Let's start with how that mix is reshaping the opportunity set in global equities. In equities, the dominant theme is a healthier, but more volatile, broadening of leadership across regions and styles. Asian stocks, as captured by a major regional benchmark, are up around the low teens in percent terms this year, outpacing other markets and signaling robust risk appetite in that part of the world. At the same time, non-U.S. equities in Europe and emerging markets are outstripping U.S. performance, helped by faster growth in dividends and buybacks and still lower valuation starting points. Within developed markets, the rally is no longer narrowly anchored in a handful of U.S. megacap tech names. Flows into sector funds outside technology have hit record territory in the early weeks of the year, and price action shows dividend growers, value stocks, and parts of the small and mid-cap universe beginning to pull their weight. Factor momentum is drifting away from high beta, speculative names towards quality and value, which typically points to a more sustainable phase of the cycle, even if headline indices look optically expensive. That said, the small cap story is nuanced. Benchmarks like the Russell 2000 have lagged, and nearly half of those companies are not yet profitable, which makes them more exposed if growth disappoints or if higher real yields persist for longer than hoped. Some commentary sees meaningful upside for smaller companies if policy rates ultimately move lower and earnings hold up, but the sensitivity to any renewed tightening in financial conditions is clearly higher here than in large caps. The biggest driver of equity dispersion remains the multi-year AI investment cycle. Hyperscale cloud and platform companies are pressing ahead with very large capital spending plans, and that is feeding through into strong results for semiconductor names, data center infrastructure, and industrial suppliers, from advanced memory producers to turbine and grid equipment makers seeing record order books. In contrast, parts of the software complex, especially in Europe, have suffered sharp drawdowns after disappointing updates, as investors struggle to value business models being reshaped by AI and to assess how much of traditional IT budgets will be squeezed by the pivot towards AI projects. There is also a sense that recent selling in some software and megacap tech stocks has overshot the deterioration in fundamentals. Earnings expectations for several large platforms are still being revised higher, and some see room for tactical rebounds once the market digests the scale of AI capex and the associated debt issuance, such as the sizable bond deal recently completed by a leading search and cloud company. Alternative asset managers, meanwhile, are under pressure despite limited direct software exposure, as markets fret about indirect AI disruption to portfolio companies and fee streams, which adds another layer of equity dispersion tied to this same theme. On the consumer side, signals are mixed and add to the need for selectivity. Some consumer-facing names, including a global quick-service restaurant chain, have delivered solid upside surprises on sales and earnings, but others in discretionary areas like toys and ride-hailing have missed expectations badly, highlighting pressure on more marginal spend. Macro data point to low consumer confidence, rising loan delinquencies, and evidence that lower-income households are cutting back while higher earners trade down to cheaper retailers. Yet internal bank card data still shows spending growing in the low single digits year on year, suggesting resilience as long as employment holds. Against that backdrop, expectations for U.S. equity returns in 2026 sit in a mid-single digit to high single-digit range, with less room for broad multiple expansion and more emphasis on earnings durability and stock selection. Positioning among active managers is only modestly above neutral, but the prevailing bullish narrative feels fragile, with sentiment wobbling quickly on any soft data around jobs or retail activity. For a cross-asset allocator, the key watch points now are whether the labor market and AI-driven investment keep growth strong enough to support this broader equity leadership, and how far delayed Fed cuts and any renewed rise in real yields start to bite into the more rate-sensitive corners of the equity market. Turning to rates, government bond markets are wrestling with a confusing mix of strong current data and weaker history. January payrolls came in roughly double consensus. Unemployment ticked down, and wage growth ran a little hotter than expected. That combination pushed 2-year and 10-year U.S. yields noticeably higher, and markets have shifted the expected timing of the first Federal Reserve rate cut from early summer into mid-year. At the same time, benchmark revisions have stripped out close to 1 million jobs from prior years, leaving last year's average monthly gains at levels more typical of a late cycle slowdown than of an overheating economy. Fed officials so far sound comfortable staying patient. They acknowledge the softer underbelly in the data, but point to productivity gains and still solid output growth as reasons not to rush into easing, and current inflation forecasts do not obviously demand lower policy rates right away. Markets, however, continue to price several cuts over the year, with interest rate swaps even nudging up the probability of an extra cut after a recent bout of curve flattening. Commentary increasingly highlights that the very front end of the curve is where volatility is concentrated, while long-dated treasuries have lost some of their punch as equity hedges, shifting focus toward intermediate maturities, where coupon income may better compensate for rate uncertainty. All of this leaves fixed-income investors dealing with elevated uncertainty and the risk of short-term air pockets in pricing. Recent weaker readings on retail sales and compensation costs have already stirred talk of stagflation risk if growth slows further while wage and price pressures remain sticky, a scenario that could steepen the curve after this latest flattening move. Gold has quietly outperformed long-duration treasuries during recent equity pullbacks, underlining that traditional duration hedges are not behaving quite as they used to. The immediate watch list now includes the next rounds of labor and inflation data, how firmly the Fed leans into its higher for longer messaging, and whether the balance of flows continues to favor the middle of the curve over the most rate-sensitive tenors. Credit markets, in contrast, still look benign at the headline level, even as dispersion quietly builds beneath the surface. There is little sign yet of a broad-based rise in defaults or covenant problems, and overall corporate balance sheets appear solid. But spread differences between stronger and weaker issuers have widened, especially in software-related credits and parts of high yield, mirroring the equity volatility in those sectors and the uncertainty around who will emerge stronger or weaker from the AI transition. One striking feature is the scale of new issuance from top-tier technology companies. A leading U.S. platform recently raised close to $32 billion in a single day, underscoring how readily these firms can tap bond markets to fund massive AI infrastructure programs, while still clearing at relatively tight spreads. Deals of that size can pull in a lot of demand from insurance portfolios and retail credit funds, potentially crowding out some high-grade private credit opportunities at the margin. In response, major private credit firms are leaning harder into digital infrastructure, viewing data centers and related assets as a way to gain AI exposure without taking direct software risk. The more traditional fault line runs through the consumer. Delinquency rates on consumer loans are now at their highest in nearly a decade, coinciding with disappointing results from several consumer discretionary companies and evidence that lower income and younger households are tightening belts. Small cap corporates, many of which rely more heavily on bank and private credit financing and remain unprofitable, look more vulnerable in that environment than cash-rich large caps. For allocators, the key is that while credit as an aggregate asset class still offers carry with limited signs of systemic stress, the payoff profile is increasingly shaped by sector selection and by how AI and consumer trends filter through specific balance sheets. In foreign exchange, the narrative is tilting away from dollar dominance, even as U.S. yields back up. On many valuation measures, the dollar looks rich versus history and at risk of mean reversion, and there is growing interest in hedging dollar exposure as U.S. policy and political rhetoric inject more uncertainty. The standout mover has been the Japanese yen, which is rallying as rising domestic rates and hints of policy normalization triggered the unwind of long-standing carry trades. That unwind not only strengthens the yen, but also has the potential to ripple through other asset classes by raising funding costs for leverage positions. Beyond the near-term ebb and flow, structural forces are also chipping away at the dollar's dominance. Trade tensions and the limited impact of past unilateral tariffs have encouraged both the United States and its trading partners to rethink supply chains and to form new coalitions around critical materials. Efforts such as a multi-country initiative on critical mineral pricing and the creation of a U.S.-led strategic reserve for key inputs used in technology and defense are part of that broader realignment, and over time may support a modest diversification of reserve and transaction currencies. Digital assets, meanwhile, are firmly in risk-off mode. Bitcoin has fallen by more than 10% this week, with other major tokens down even more, and brokerage data show a steep drop in crypto trading revenues. Many participants now explicitly link that weakness to the perception that the Fed will not cut rates soon, which undermines the popular narrative of crypto as a straightforward hedge against currency debasement and makes it trade more like a high beta asset sensitive to real yields. Yet at the same time, the underlying blockchain infrastructure story is advancing, with major exchanges exploring tokenized equities and firms like Robinhood and PayPal building rails for trading and using tokenized real-world assets, suggesting that tokenization as a market structure theme can progress even through cyclical drawdowns in coin prices. Commodities present a strikingly split picture. In oil, geopolitical tensions are offering some support to prices, but the fundamental balance looks heavy, with inventories rising and forecasts pointing to a sizable supply surplus over the year. That backdrop argues for downside risks to crude benchmarks unless demand surprises positively. And if prices were to move decisively above the low 70s in dollars per barrel, the expectation is that key producers would respond by opening the taps, which could cap further gains even as it gradually erodes spare capacity. Industrial metals tell a different story. Nickel prices jumped after authorities in Indonesia, home to the world's largest mine, ordered a dramatic cut in ore output to help stabilize a previously oversupplied market. That move underscores how policy decisions can rapidly tighten conditions in battery metals that are central to electric vehicles and storage. China's producer prices are still in deflation, but the pace of decline has slowed, helped by a global rally in metals linked to AI, electrification, and infrastructure. Layered on top is a wave of strategic initiatives, a U.S.-backed critical minerals reserve, plans to ease domestic permitting, and a coalition of more than 50 countries seeking to set fairer terms for mineral trade, all of which point to sustained capital spending in this space. The energy transition theme is also gathering momentum in listed markets. Demand for utility-scale solar and battery storage is surging as data centers and AI-driven computing load strain existing grids. And solar plus storage is now seen as one of the lowest cost and fastest to deploy options, with projects coming online in just over a year in some cases. Recent deals, including a well-received solar and storage IPO and record turbine orders for gas generation linked to data center demand, highlight how capital is being pulled into this ecosystem, even as supply chain bottlenecks and specialist components constrain the speed of build-out. For portfolios, one notable shift has been that gold has lately done a better job than long-duration treasuries as a diversifier during equity stress, reinforcing the idea that commodity and rate hedges are evolving together rather than moving in lockstep. Stepping back, the cross-asset picture today is one of noisy but still resilient, growth colliding with a slower and more contested path to easier money. Equities are digesting that mix by broadening leadership across regions and sectors, with AI-linked capex and energy transition spending creating powerful tailwinds for some industries, even as consumer and software names face greater scrutiny. Rates are adjusting to stronger near-term labor prints and hotter wages by pushing out the first Fed cut, while the deeper revisions and soft spots in recent data keep the door open to policy easing later, leaving the curve in flux and front-end volatility elevated. Credit remains supported in aggregate, but dispersion is widening in AI-sensitive and consumer-linked areas, making security and sector selection more critical to the overall carry story. In FX, a softer dollar, a resurgent yen, and ongoing deglobalization themes are reshaping currency risk, just as crypto trades more like a high beta expression of the higher for longer rates narrative. Commodities round out the picture with oversupplied oil, tightening battery metals, and strong demand for solar, storage, and critical minerals, while gold increasingly shares the hedging role investors once assigned primarily to long-duration bonds. For allocators, the key watch points are the next wave of labor and inflation data, any shift in Fed communication, how AI and energy capex filter through corporate earnings, and whether currency and commodity moves start to signal a more decisive turn in the cycle. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.